Hello, everyone. Hopefully you all made it this far to this is CoMotion Lab's first virtual event. It's a new world for all of us, so we ask your patience as we host our first Fundamentals for Startup on Zoom. A couple of announcements before we get started. At this time next Friday, JP Nichols will present Bankers Are for Mars, FinTechs Are from Venus, Lessons for All Entrepreneurs Working with Conservative Corporate Partners. JP Nichols has been internationally recognized as a leading voice for innovation, strategy, and leadership, and his work has been featured in top publications and conferences around the world. All of our Fundamentals for Startup presentations are archived on our CoMotion website under our Startup Training Videos tab. We have covered a variety of topics over the past several years. So if you do find yourself with some free time these weeks, check out our past talks. For our full upcoming schedule and to register for our future fundamentals, please visit comotion.uw.edu/events. Our speakers today are Ken Meyer, Dan Rosen, and Xiao Wang. They will be discussing how to negotiate startup life during a crisis. Ken is an interim executive who helps companies navigate challenging business transitions and is a lecturer on leadership and commercialization advisor at the UW. Dan is chair of the Alliance of Angels and CEO and president of Dan Rosen and Associates, an early stage technology investment and advisory firm. Xiao is president and CEO of Boundless Immigration, a technology startup whose mission is to empower families to navigate the immigration system. I will now turn things over to Ken Meyer.
Carolyn, thanks a lot. Hi, everybody, and thanks for taking the time to plug into this Zoom session. We are really honored to have both Dan and Xiao here. We thought the subject was timely, given what we're all navigating through in our personal lives and our professional lives. It's a very somber time, very anxious time for everybody. This crisis has impacted us all very personally in very different ways. We are in a state that today has approximately 500,000 people who have filed for unemployment. As of a couple days ago, over 9,000 cases of COVID-19, and sadly, over 400 deaths. And perhaps on the brighter side, though, is that there is a sense that we are flattening the curve, that we got on top of this appropriately, and that there's some hope here that over the coming weeks we'll see the light at the end of the tunnel. But these times are particularly hard for startups, not surprisingly. And we thought it would be valuable to have a conversation with two individuals who are living this day in, day out. Xiao, who runs Boundless Immigration, is feeling this personally as the CEO and founder of a startup. Dan, who has been an investor and an advisor and a founder of Alliance of Angels, is also living this in spades, given the companies he invests in and his experience in the industry. So we thought we'd have a conversation about the challenges of navigating the terrain we're in and the months ahead. These are all, candidly, everything is guesses here. We're in uncharted water, so we're making speculations here about how you might navigate this. And we want to make sure we get your questions answered if we can. So this is going to feel a little bit like a webinar, so we're going to kind of control the conversation. But if you want to ask a question, if you look at the tab on your chat button, you'll see my name, Ken Meyer. Don't hesitate to put a question in there, and we'll try to make sure we cover that. So let's start this off. I'm going to start with Xiao, because Xiao, you're living this. I guess first thing I would ask you if you could do is perhaps explain your business to the folks on this call so they understand the context that you're working in.
Thanks, Ken. Hey everyone. So my name is Xiao Wang. I'm the co-founder and CEO of Boundless Immigration. So we are a Seattle-based venture-backed technology startup that's basically trying to transform the immigration process. As an immigrant, and yeah, if any of you are yourself or you've known the people, I don't think anyone has ever said positive things about their immigration process or felt delighted at all in any part of this journey. And what I found was that it's one of these situations that everyone's just taken for granted for far too long, that in order to be in the US, you have to go through this gauntlet and this rite of passage that's the immigration process. But if you really dive into it and peel it back, you realize that this is actually an information problem. The immigration system is hard precisely because no one knows how to do it right, and it's so high stakes. It's literally one paper application that can determine the future of your life, of yourself and your family. And in a world where I would argue that technology has gotten a pretty bad rap over the last couple of years of solving, menial problems for the privileged elite, like this is exactly the type of problem that technology and data is meant to solve. It's like, how can we translate all of this information that's previously only in the heads of the federal government or expensive immigration lawyers and make it available to everyone and give finally everyone a partner through this process. So we started this in 2017, so 3 years ago now. And I went through a accelerator program called Pioneer Square Labs that I'm happy to talk about later on. But as we have, I would call our trajectory so far until March up and to the right. Okay? We were growing, 3 to 4x year over year. Was able to become the largest player in our industry. We have 100% approval rates, which I'm really proud of. We were able to raise our Series A in the middle of last year, so 2019, with some great investors. And we are on fire to start 2020. And the intent was that we would demonstrate significant growth in the first quarter and 2 quarters of this year, and then potentially go out for our next round later on in this year.
Thank you,
That
Xiao.
has changed.
Yeah. So, Xiao, thank you for that introduction. So first question for you is, when did you first notice the impact? What was the sign that said, uh-oh, something's happening here?
So I would place it in 2 different buckets. So the first is from our business and from our business operations. And for that, I'm very proud of my leadership team for doing this, is that we actually shut down our office and made almost everyone work from home a week or more than a week before the other major companies in the local region did. And my executive team made this decision as they saw the different recommendations and guidelines coming out while I was actually on paternity leave. Literally, it was the week that I had my child. And so that was early March. What we started noticing then was a dip in the top of our funnel. So if you think of everybody's business as a different set of funnel, but our top means that a customer comes on our website and starts their application with us. And it was a pretty precipitous step. And what's scary is that when you compare it to the first couple months of the year, the first week of March, we were down about 10%, which could be attributed to any number of reasons. The second week, we're down 20%. Now it's starting to get worrisome. The third week, we're down 35% or so. The fourth week, you're down close to 50%. And at that point, you're like, well, where is this floor? Where is this floor going? And so between weeks, I would call 2 and 3. So when we were down about 30% and it wasn't, and it was accelerating, is when we started to do some serious planning and steps taking in response to this situation.
Great. I'm going to hold you for a moment, and I'm going to shift to Dan. Dan, maybe you could tell the team a little bit about your background, and then I have some questions for you about what you're talking to your startups about. Oh, your mute is on, Dan.
Some people would argue I sound better with muted. But no, I have been described as somebody who doesn't seem to be able to hold a job because about every so many years I have to go do something new. and I have been at various times in my life a research biophysicist. Got my degree from UC San Diego, and then was a corporate executive, worked at Bell Labs for a while, did a couple startups, and then joined Microsoft, or AT&T first, and then Microsoft, and was very involved in the early days of the internet. Left Microsoft, became a venture capitalist, and have been doing angel investing for probably about 30, 35 years. Portfolio in total of over 100 companies, currently have about 60 active. And by the way, one of my investments is Pioneer Square Labs. I love them. And because of my background as a biophysicist, when I heard about COVID-19 in China, I knew it was going to be a global pandemic. Things like this just don't happen. And then as the data began to come out about how it was going to grow, you know, a lot of people just really don't understand the concept of an exponential curve. And for those of us that did, it was pretty obvious that this was going to have effects. And because I've invested in a lot of med tech kind of things as well as tech, I was aware that the big danger here is that if the curve went above the capacity of the hospitals in the US, which could very readily happen with a novel virus for which there is no herd immunity and no vaccine, that was going to be the real problem for the country. And so I saw very early on that this was going to have not just medical impacts, but huge economic dislocation, at least for a year. And so
hold on. So when you, that's super helpful for introduction. When you look at your investments, without having to give any names away, what are you hearing about what the impact has been on your portfolio companies?
Well, I do this in the context of the living through the 2000, 2008, and to some degree the earlier market dislocations that happened. And so I started looking for leading indicators early on. And what I'm hearing is that, this is very similar, by the way, to what's happened, particularly in the 2000 dot-com crash to the dot-com companies. What you're seeing is investment dries up overnight. Companies find that customers who were in the hopper ready to sign, they can't even find anybody who is there to sign anything. That all the business plans they had written did not include situations like the ones we're in front of. So companies were really looking for a little bit of guidance. They weren't quite sure what to do.
Okay.
And
Okay.
that led me to write that memo that sort of has gotten widely circulated now about what to do.
Okay, great. Yeah, so for those of you who don't know, Dan wrote a blog post that was then picked up by GeekWire. That's he's getting a lot of invitations to sessions like this, and in a short time we'll have him share some of his thoughts about what he sees the future to be here in the short term and some recommendations. Xiao, so this your funnel starts to dry up. You are thinking to yourself, I got to do something. How do you approach that? How did you approach that? What went through your mind? What decision process did you use to go through this, to decide what you wanted to do? And then what did you decide to do?
Yeah, so, you know, to use like an overwrought term, right? We've just instantly transformed from peacetime to wartime, which means that, you know, it's about, you know, and to take the first line, I think, of Dan's like memo, it's like, first line is how to survive. And then the second point is like, well, how do we get ourselves in a position where we can thrive at the end of this? And so surviving for startups is all about cash. And so in my mind, it's around how do we have enough cash to make it through to some hypothetical future world where the economy is better and that additional fundraising opportunities are available. And so in my mind, that was, I pulled a bunch of other CEOs and other investors and settled around 18 months, right? I'm not a fortune teller by any means. But the idea is if we can get to 18 months, that gives us a year for the economy to recover, 3 to 4 months to show dramatic growth at the end of this in some way, and then 2 to 3 months to raise our next round. Okay. And that became like a North Star, which is, hey, how do we get to that 18 months as soon as quickly as we can? Because if you took our burn rate at the moment and the amount of cash we had left in the bank, we were not going to come anywhere close to that. And so then it becomes a math problem, right? How do you get more cash to shore in your bank account, step one. And then step two is how do you reduce your burn rate? And the short run answer is not going to be coming from growth because we logically aren't going to find growth in the short term. So it's about where can we cut costs and where can we change working capital potentially to start generating more cash.
Okay. So how dramatic have your actions been? Without giving anything away that you would not want publicly known, what kind of actions have you taken that you can talk about?
Yeah. One of the things I wanted to start with, and we're very lucky because other companies are not like this, is that I could see a world where we could get our runway to 18 months without dramatic changes on the personnel front. And I think that every company is different. Now, like the standard mantra, which I strongly believe in, is if you have to make cuts or if you have to make changes, you do once and you do it deeper than you want it to be done. And so, although that was always in our toolkit, the first step was, what is everything that we can do? And I used it as a motivating factor for the whole company. So I was open about this as we went along the process. We need to hit this number. What is everything that anyone can do to get us to that number so that basically the gang can still stay together? And at this point, we're at about 50 FTEs. And so it's really about, obviously freezing headcount, right? No more hiring, no more backfilling, no more, we actually, and I feel really bad about this, had extended offers that were accepted for people starting in the future that we then have pushed off in timeline. Every expense line now gets renegotiated. Literally everything that we spend is a conversation back to that either do we need this anymore? Do we need as much of it? And can we get it for less? And then simultaneously, what I can do as a CEO while the team is working through and cutting through all the line items is trying to get more cash in the door. So right now there are two, one is I negotiated a line of credit from a bank to just be a term loan. And then the second is that as part of these stimulus packages, there are a number of different programs, the government programs that can either cover payroll for a period of time, give you a low interest loan, or waive payroll taxes. And they're remarkably more complex than they should be right now. But for each company and each head of companies, it's their responsibility and obligation to sort through all of the government paperwork and figure out what the right path is for them.
Okay, so in summary, what I'm hearing you say is you were lucky in that you did not have to take dramatic headcount, but you just basically looked deeply at every line item, stopped all hiring, and you sought to renegotiate some things, because I know from personal connection, there was one element there, and I'd like to talk a little bit more about how you might have approached that, which is you have a lease, you have health insurance costs, you have a variety of big line item numbers other than, you have a certain number other than people. Be interesting to know about that. I'm gonna, before I go do that though, with Dan, so now you're talking to these companies. We have folks on the line who have established companies, who are just getting their company off the ground, getting their first set of customers. what's the single piece of advice you would give them, or a couple pieces of advice?
In the 2000 dot-com crash, and then again in 2008, a lot of really good companies that should have survived failed. And that's going to happen now. We're going to have a lot of companies that I had really high hopes for that just aren't going to make it. And so the number one thing that you have to do if you're going to make it to the other side is survive. I mean, it's sort of an obvious statement, but it is the most important thing. You go into survival mode and you do what Chow did. You triage absolutely everything. Your goal should be to reduce your burn to a point where you have 18 to 24 months of cash in the bank. And you should revisit every one of your business plan assumptions. At the end of the day, there's one mantra that I say, and I say this to startups even in good times: cash is king. You just have to make conserving cash and managing your cash job one for the foreseeable future. And that's hard because we've come from a period of expansion now that has seemed unending, and we have a whole generation of people who never went through anything that looked like a dislocation or a downturn. And so this is a change of mindset from I need to grow my business as quickly as possible to I need to survive. And not everybody is going to do what Chow did and figure that out early enough. The problem with cash is king and survival coming together is it's sort of like the COVID exponential itself. What you do early has so much more impact than what you do late. So I advise every startup to, if you haven't begun this process already, you're probably late in the game. Start it now and start it dramatically. But you should have started it a while ago, and you should figure out exactly what you're going to do to survive. What are those strategies for your particular business that you need to do to make it through for a while, at least 18 to 24 months.
So let's say I am a startup, Dan, and I am earlier than Chow. I've got maybe an angel investment, and I've got maybe a few $100,000 or something, and I'm in an incubator someplace. And is it reasonable for me to go back to my angel investor and say, I'm going to go get a job, and we're not going to spend more of your money right now. We're going to wait 4 or 5 months. We're going to take care of things, and we're going to work on the business, but we're not going to spend any of that cash for 4 or 5 months. Are you okay with that?
It depends. It depends upon your business. In some cases, that's a perfectly reasonable answer, but in some it may not be. But you're making a different point that actually last couple of days I've been meaning to sit down and write yet another blog post on, and that's communication. Probably the number one thing that a leader needs to do at this point in time is communication. You need to be able to communicate with all the stakeholders in your company, not just the people you work with, but also your investors and your customers. And you need to communicate well with them what your plan is going to be, and in some cases seek their advice and knowledge and see what you can pull off. I think there are still angels who are investing. There are people who fell in love with the companies they invested in and they want to see them succeed. And you need to be able to communicate with them and tell them the story they need to hear about what you're going to do to take the money that you get and make it last long enough to show that your business can still be there. Ken, people like anecdotes, and I'll tell one out of the 2000 timeframe. But I was a venture capitalist at the time, and the third investment of our fund was maybe not what many would consider the wisest investment, but we love the team and love the area. They did marketing automation. They weren't the first. They were about the sixth marketing automation company, but they were out of Indianapolis and had a different approach. And we thought that they would get out and go public, but then the crash of 2000 came. Because they were in Indianapolis, had not raised that much money, they were able to cut their burn and survive. And of course, the plans they had didn't materialize right away, but they kept going and going and stayed alive. When the market finally turned around, almost every one of their competitors had gone under because they had much larger burns and couldn't survive. And they didn't take the actions to cut it, but these guys were able to do that. And as a result, 10 years later, they were bought by NCR for $600 million, and it turned out to be a great exit.
Okay, thanks, Dan. Xiao, can you talk a little bit more about anything else you found you were able to do to cut your burn rate? And then talk about what you're telling your team about what they need to focus on?
Yeah, I mean, to echo the transparency thing, I have been on the oversharing side. And I feel like, especially in times when you need people to make sacrifices, or if you need people to really dig deep, it's more effective than trying to keep things close to the chest. So I, shared with everyone our screenshots of our bank account, right? And shared with everyone like our financials every month as it happens, of like, this is what is going on. One of the areas that we didn't talk about yet that different companies have in their repertoire is the ability to improve their working capital position. So, whatever hurdle rates or other aspect that you've had before, you are willing to pay a lot of money right now to get cash in the door sooner. And so, we had a payment plan kind of option, and we are now paying a premium to basically get cash up front rather than over time. And that's a lever that different companies have different abilities to pull. But that is something that is very important in a world where cash is king.
And this is payment from your customer?
Correct. And so for others with, let's say, subscription plans or other things, like the more that you can sell annual upfront rates, the more that you can sell like programs where you get more cash today than the better in this current state. And so, what we have been able to do as we've gone through all of these areas is to talk about how we've dropped our burn now by over $100,000 a month. We still have some room to go. And then also, to your point, Ken, it's like we looked at all of our contracts, right? We not only if they're necessary, but to renegotiate. So that incorporated like the big buckets, right? In terms of leases, looked at like benefits, looked at all these different SaaS subscriptions, looked at all of our different partners, and know that and I want people to think carefully about if this is a one-time game or if it's a multi-part game, because in some ways, like everyone is struggling here. And you have a fiduciary responsibility and obligation to save your company. You also want to have a world where once you come out of it, people still want to do business with you. So think very carefully about, how you want to treat each vendor and each partner, but make sure you have those conversations, right? It is, in this time period, I think I haven't heard no from, I don't think anyone, in regards to either can we, defer internet payments until we're back in the office, right? Can we, lower billable rates from legal counsel and accountants? Can we, get more seats at the same price? Or like every aspect of every contract you have is negotiable. So, stop all automatic payments, stop all like ACH withdrawals, and then take each one as they come along with a very careful perspective.
Okay, great. Dan, how would you, this is your, I can't have you speak for all angel investors, but how would you characterize the investor mindset right now, in your opinion?
Well, first, let me compliment Zhao on what he did. I think that you could write the manual about what every startup ought to be doing. So great job. Investor mindset is a funny thing right now. And again, I can only draw on previous experiences to sort of forecast where it might go. Let's start with venture capitalists. And most venture capitalists in previous crises have gone to ground. They've looked at their portfolio. They've tried to prioritize the funding into the companies they were going to have. And in previous crises, particularly in 2000, you saw a lot of limited partners forego capital calls. So venture capital funds really struggled during that crisis because they thought they had a certain amount of capital, and some of the people who were investing in them decided they couldn't. And the reason is simple, that institutional investors have a certain percentage of their assets that are allowed to go into what are called alternative investments that include venture capital and investment in startups. The problem is that when your equity portfolio drops by 40% in value or 20% or 30% in value, the ratios go out of whack. And so a lot of large institutional investors will change the way they invest. And what you'll find is venture capitalists are going to do triage. They're going to look at their portfolio and say, you know, this company, this CEO may not have made it anyway. We'll just drop out of this deal, let them go under, but we'll focus our attention on these other three instead. Angels behave differently. And the big difference between an angel and a venture capitalist is angels are investing their own money, not somebody else's. And they have to decide, am I going to reach into my pocket, take out my checkbook, and write another check to a company? I would urge one of the changes that I hope that this crisis does engender, sort of back to the future, is that every employee at a startup behaves the way Zhao and his team are behaving, that they consider themselves owners of the business, not employees. And therefore, they behave like owners would behave. They treat the cash that they have as theirs, not as a gift from somebody else for them. And therefore, they manage the cash very carefully, communicate that to their investors, and they will find that angels in particular will continue to invest during a downturn as long as the value they seem to be getting is commensurate with the risk, and that the company seems to be taking this as seriously as they are. That's really the essence here: the communication and treating cash like king, and figuring out what you're going to do to survive past the downturn.
Okay. Zhao, I'm interested as you to shift a little bit to growth strategies. As you look at your business, you look at what COVID has brought, do you see opportunities to either reshape your product or to adjust your business model or your strategy? Or, you know, just as has it forced you to relook at anything fundamentally about your products or services?
Yeah. So we're working on a new set. Like, one is, you know, you throw all projections out the window. Right? So like, let's just call this a wash. And, you know, from my perspective as someone who does not have a route to profitability within the confines of my current funding situation and balance sheet, which means that I'm going to need to raise another round for us to have the opportunity of getting to a point where we can be profitable and call our own destiny. So I'm optimizing around what would get me that next round successfully, which means that, like, if I were to think about this world, it's like I can as long as we can get to the survival point, and Dan, maybe earmuffs here, I can just write off this period, right? Like, let's just assume, like, don't even worry about it. COVID happened, like, ignore any trend lines from like this period. And then it's all about like, how do we look at the end of it is what we're going to be judged on for the next round. And so therefore, like the way we look at it is like, first, it's keep the ship from sinking. So right now, this next quarter, fundamentally, all of our product efforts, growth efforts, et cetera, is very short-term focus, maybe lower expected value, but also lower risk. Everything we do is certain, right? We look at all of our Facebook and Google data and like take out anything that's experimental, right? Only spend money on things that you're confident in, like have a positive return, right? You cut all sort of long-term efforts for sake of short-term optimizations and initiatives. We have a successful inside sales organization. So like, how do we make them more efficient, right? As opposed to invent a new channel to go find customers. So that's like the first part, keep the ship from sinking. Now, once at some point, which hopefully we'll get to this quarter, where we feel like the ship isn't taking on more water, then it's actually around how can we make ourselves more efficient so that when the tailwinds come, and I'm going to beat this now shipping analogy to death. So when the winds come at our back, we can fly a lot faster than we were before. And so it's actually about investing now. Next phase is in automation, efficiency, like speed things, like scale areas. Because again, I can convince any investor that just ignore growth rates in 2020, only look at like where we are in 2021. And so
Xiao, the analogy, Xiao, that I've been using is, what is everybody doing right now at home? They're cleaning out their closets, right? They're fixing things that have been on the list to fix, right? They're getting that they realize they have an opportunity to do some things that position them better than, because they're not going to have the time to do those things. So, Dan, I'm going to ask you, do you see opportunities here for either new business opportunities or trend opportunities coming out of this?
Yeah, sure. I mean, following Xiao's tough because he gets all the good points in before I make them. But I will say that, you can look at this as an opportunity for us all to learn. And the fact is that we, for reasons of history, got a little sloppy in some of our business practices. We decided time to market and market share and other things were more important than efficient operations. And so as a result, we spent more money than we needed to create some businesses. This period is going to teach us the lesson Xiao just talked about, that it's important to make sure that you can operate a business as efficiently and effectively as you can, build it to be an ongoing, good, solid cash flow business over time, and investors will do that. One of the other things that's going to happen is that valuations are going to be much more fluid in the next year. So there's a question that people are asking. And is this recovery going to look like a V shape, and that we're going to hit the bottom some point in May or June, and then it's going to come right back to where it was within a month or two? Or is it going to be more gradual in a U shape that has an extended recovery period? I'm betting on the latter. I don't think it's going to bounce right back. I think that things are going to change in a lot of profound ways for a long time. Given that, there are opportunities, and I'll you know me, Ken, I like to use examples and anecdotes, but one of the anecdotes I'll use is a company Ken and I are both involved in, Transformative Med. They supply electronic medical record systems add-ons to hospitals to make the docs and nurses and other medical practitioners more effective in their daily jobs. When this came up, we immediately all jumped to the conclusion that they had a role to play in making the hospitals work better with COVID-19. And they released a COVID-19 module in 1 week of work that has now been deployed at Harborview, Evergreen, and about 6 or 8 other sites.
Oops. Dan, you froze up a bit. When I'll shift gears here while Dan gets back up to speed. Xiao, I'm curious, what's it like? We're all now doing these Zoom conference calls. What's it like to manage remotely? Well, how's your team adjusting to this?
So we're on week 7 now of being remote. It's hard. And I think that the first thing that everyone, if you haven't already named it, is to say to your team, this is really hard. All right, there's a lot of things that we don't know. There's a lot of, and this, especially as a company that didn't start remote first. And also you add on to the family side, right? There's like pets roaming around, kids roaming around. There's a lot of stress in people's lives. And just talk about how hard it is. I found that for one, Zoom meetings back to back all day are exhausting. Much more so than like in-person meetings and conversations. Probably because I'm not walking from one place to another, probably because I can't move around, or you have to always like try to pay attention to what your face looks like on camera. There's all these considerations. So how can we help people free that up a little bit? How can we still try to create deep personal connections across the organization? Zoom is also terrible like group conversations. I don't know if you've ever been to a Zoom party. It like reminds me of like a middle school like dance where you're all standing in a circle and then one person talks and everyone listens to that person talk, and then you're afraid to jump in because if you do, now you have a 2-person conversation in front of 30 people who may or may not care about your conversation. How can we find more intimate ways of creating that bonding? And it's something we haven't figured out. We're just trying to take things and learnings, one day, 1 week at a time. We're continuing to try new things here. One thing that I do that my head of people ops came up with that I think is really valuable, and maybe we'll see what happens when Dan comes back, is a no apologies rule, right? There's so much of life that's happening. And so we now no longer apologize for if your internet connection is crappy, or if like a kid is screaming in the background, or that like something is really messy, or like you look like or in my case, like I haven't shaved in weeks. There's so much of life that's happening, and so if we start with like we're really empathizing with each other and we care about each other and we think best intent of each other, then and you sort of remove that layer that you're always coming in feeling like you're not being yourself or you're not being 100%, then you can feel more confident in your interactions, and you can move forward more so than like dwelling on all the things that are gaps.
Great, thanks. Hey Dan, welcome back. I've got a question that's a question for you. And by the way, everybody, we've got about 15 minutes left. If you have other questions that you'd like to ask Xiao or Dan, don't hesitate to put them on the chat function and we'll give them to them. Dan, somebody asks, what if a brand new startup has a great idea, is ready to get started? In this situation, it will take about a year to get to market and become active. If we use Xiao's assumption of 18 months, is it even conceivable that an investor may still be interested? Or should all brand new startups looking for initial cash plan on waiting, putting everything on hold until we return to some sense of normalcy that would be a better environment to begin?
That is a fabulous question. The answer is very straightforward. It depends. And if you have a business where the plan can be financed on sort of a minimal amount of cash to get to a point where you have a viable business and then you need growth capital, you have the opportunity to still raise money for that business. if on the other hand, you have a business that's going to take, I don't know, $10 million to get to a proof point to find out if it's going to work, this is not the time to be starting a business like that. Unless you have somebody lined up who's going to fund you through that valley of death. Because it's hard to start businesses that have very high capital needs, and they're really not angel-oriented businesses at that point.
Most of the folks on this line likely are not capital intensive, I'm guessing. As you look to let's take this question a second time. Let's say I'm coming to you, and my solution presupposes that the customer is in a more stable kind of non-COVID environment. I don't have a solution that is helping to address the COVID solution, or which likely would align with your beliefs around kind of trends that will continue. Perhaps more online collaboration will continue into the future, or adults will now discover casual gaming and it'll stick from here on out. Let's say it's a business where it doesn't meet either of those requirements. What would you be looking for aside from the classic, the team, and is there anything particular that you would look for as an angel investor or a venture investor? Would you want to find, would you tend to prefer something that looked like it was going to harness long-term new trends that they are pitching, that somebody's pitching, which says basically, I believe this theory of change is going to happen, or are you looking for something that is right in line? You know, what would be more attractive kind of to you or to your peers, do you think?
I think that's sort of an impossible question to answer.
Okay.
I think it depends on if you have a great team that has a product that is a good product. I mean, the classic example I've heard cited, and I love the analogy, is if you have the only refrigerator in the desert when people want cold beer, you're going to have a successful business no matter what you do. And so we look for businesses that are sort of like that, with a great team and a great idea that isn't just a tiny incremental improvement on the way things are, but is a big improvement either from a cost, like a half the cost for the same product. But if it's only a 10% improvement, then you're not going to succeed in this environment or most likely in any other.
Okay.
So you're looking for something that is going to be there. I mean, you know, and there are going to be exits that happen during this period as well. Some of the big companies that have been negotiating with companies they've been involved with for a while, or at least like them, are going to find great opportunities to buy them now. And so from an investor point of view, you get a lot of great companies created in down markets.
And can I jump in here real quick, Ken?
Please.
It's like, yeah, out of like the investors that are both on my cap table as well as others that I know, this is actually like to start a company. If you have a great idea, a great team, things that Dan said, this is actually a great time to do that. Right? Like some of the best companies come out of downturns. You look at 08, 09, like all the companies that we're gushing about now, were all created during that period of time. It's the hardest time right now is actually for earlier stage companies that are not profitable, that we're about to fundraise, or we're in the middle of trying to raise a round right now, who are, you know, just coming up against a cliff. Right? That's terrible. Yes, valuations are going to be down. Diligence is going to be a little longer. But there is a huge number of early stage seed funds that have been created and formed over the past couple of years. And so if you have a great business model, like now is a great time to like push that forward.
Hey, Dan, I asked Shao what it was like to manage a remote team now. He said into his 7th week. I would ask you, if I can't meet with investors, how do I communicate with them during this time?
That is really a good question. And we're in uncharted territory here. I think that a certain amount can be done via Zoom. I think that you can tell if somebody has really excellent leadership and communication skills via Zoom. But at the end of the day, most of us like to actually sit down and look somebody in the eye and say, are you somebody I want to back? I also think this is a great time for investors who have done it on their own for a long time to think about doing this in groups rather than as individual. Because you may know somebody who's already met with the investor who has some insights that you don't have. And that's why I think that this, look, the Alliance of Angels happened in the aftermath of a downturn. And I think that most angel groups are going to see two things happen. One is the need for them is going to go up, and the number of sort of fair weather angels are going to go away. So the combination of the two is probably going to be a really healthy thing. I also urge people, don't be very careful about your investing now. It's okay to be very, very careful, to negotiate good terms, to be ruthless in deciding what you fund and don't fund. But don't take that to the limit where you kill a good company by giving them terms on a deal that make the company unfundable going forward. So it's a delicate balance, but that's where working in a group and having some experience can be really helpful during downturns.
Okay. Hey, so we have time for just a couple more questions. Here's one of them. There are some standard metrics and forecasts that investors look for or look to assess the likelihood of success of a new venture, potential market size, customer acquisition costs, et cetera. Do you anticipate that there are new or different metrics, either during this period or after the U-shaped recovery you described, that investors will now look for? You mentioned efficiency. Is efficiency going to be more important, or is there other things that you think investors are going to be looking for than what they normally would?
It's always been important to me.
Okay.
I don't like businesses that are taking in a bunch of cash. I mean, the old story is when you walk into a conference room of a startup and they just bought 20 Aeron chairs to go around the table, and it's in an expensive real estate place, you sort of turn and walk out right away, because that's not what you want to back. I mean, many of us know David Giuliani pretty well, who did Sonicare and Clarisonic and had such great hits. One of the things we all loved about David, besides his communicating skills, were that you'd walk into his offices and he didn't have Class A real estate. He went for very low cost, very efficient things. He'd buy used furniture, clean it up. The offices were immaculate, but they were not expensive. And that's the kind of thing I look for.
Okay, great. Let's see if I can get another question up here. Well, there was an interest as to whether investors would look at a startup if more attractively if they had received grant money from the federal government, let's say.
I urge this all the time. I think a company should look at every source of non-equity financing they can get. Yeah. I think that I know a lot of my companies are in the middle of applying for the payroll protection program, which at this point is almost as mythical a beast as a phoenix would be. But ultimately, I think it will begin to happen, and it's a good thing. I think that, again, use every tool at your disposal, downsize. 3 of my companies were proud to announce that they cut payroll, 2 at 40% and 1 at 50%, or cut burn rather, not payroll. And in almost every case, the executive team agreed to take a 50% cut in salary. And those are the kinds of things that you really need to do if you're an owner of a business and you're trying to conserve cash and survive. by talking about leadership, a subject that's near and dear to my heart. Xiao, leadership lessons that you're picking up through this experience?
There are a lot. I mean, I think Dan has been too kind. I think we've sort of felt our way through this through like bumps after bumps and mistakes and after mistakes. And the most important part is always just trying to learn from it. The one thing that coming back to my point about transparency earlier, one of the areas that I didn't do well was in the early days of my communications with the company, even if I was talking about our financials and even if we were talking about the trends, I never directly addressed the topic of layoffs or reductions in forces and pay. And I did that because I didn't know the answer to it. And I was scared to bring it up, thinking that that would cause more like churn across the organization. But what I didn't realize, and I should have in hindsight, is that people are going to talk about it no matter what, right? You open up any news site right now and it's just layoffs after layoffs, and all of these companies and people that have friends who've been furloughed, and it's like it's all on people's minds. And so it actually was a lot better once I named it and said, okay, well, yeah, obviously we can't commit to anything, but we don't want to do this, and these are the things that we need to do, and these are the numbers that we need to hit so that we don't have to do this. And that was it was successful, but it was about a week too late after people were like, murmuring around and asking this question obliquely. And so I wish I were more upfront and talking about the hard topics.
So I'm going to bring this session to a close. On behalf of everyone here, I know we're thanking Dan and Xiao for taking the time to share their great thoughts with everyone here. Before I turn it back to you, Carolyn, to maybe highlight again what the next event is through the Startup Fundamentals program, I just leave you with a leadership thought for those of you who are going through this. It's super difficult to lead others if you can't lead yourself first. And so it's so important to take care of yourself and, physically sleep, self-care right now, self-compassion, giving yourself a break right now is super, super important. This is a phenomenal development experience for you as a leader. Their crucible moments in our lives are what shape leadership moments. And so if you can see it as a learning opportunity, you're going to come out of this thing a much more effective leader today and down the road. So thanks for taking the time for this session. Carolyn, is there any final thoughts you want to provide?
Yes, I just want to thank our speakers for giving their time and expertise today, as well as everybody who was able to join us on our inaugural Zoom event for Fundamentals. And I just want to remind everybody we'll be having a FinTech talk next Friday, but learning lessons for all entrepreneurs working with conservative corporate partners, and to visit our website for registration information. So thank you all.
Thanks, everybody. Have a great day and weekend. Thank you, Xiao and Dan.